right? It will be, Barack Obama's deregulation caused this, right? That's what they'll say. So, we knew he shouldn't have canceled the public option. All right, so let me push you even further then. If you guys can handle the federal, wait, you don't know what I'm going to do. If you can handle the Federal Reserve, let me say, I think the next step for those of you, if you read a few of the introductory books or whatever, and you really want to push the thing further, really, in terms of the economics, it has to do with fractional reserve banking, okay? And that's, I'm embarrassed to say this. I taught for 3 years at Hillsdale College. I would teach the introductory macro class, and that's where you go over the fractional reserve banking stuff and how the Fed buys a check for that or buys bonds, and then then commercial banks make more loans and it multiplies. And I've taught that thing, but even I didn't really get just how perverse fractional reserve banking was and the intimate connection between that and the indebtedness of Americans. And it was only until recently. So again, it's a very subtle thing. Let me, in the few minutes I have left, just sketch the argument. So at the very least, when you hear people talking about this, you'll understand where they're coming from. And I was toying with whether I should even go down this route today, but I was talking to a guy at lunch, and this is his thing that keeps him up at night. Is about fractional reserve banking. So it sort of pushed me over the edge. So let me just very briefly sketch this for you. So what's the process? And fortunately, if you guys have read *End the Fed* or books like that, some of this will be familiar to you. So when the Federal Reserve wants to inflate, when it wants to ease the credit markets or cut interest rates, what does it do? It goes out and typically it buys an asset from the private sector. Usually it would be a government bond. Now with this crisis, Ben Bernanke has broken the rules and he's buying all kinds of things to bail out his buddies. And so we're all familiar with that Bernanke writes checks that are literally just drawn on nothing. They just create new reserves out of thin air, right? It's not that Bernanke has been babysitting and cutting lawns and he's got a bunch of money saved up, and now if he wants to bail out Citibank, he says, well, you have my savings. No, I'm going to give it to you because I'm such a nice guy. No, he writes checks and buys these toxic assets, just creating money out of thin air, all right? So I think we're all familiar with that, and we know that's crazy, that that's the fiat money aspect. But it doesn't stop there, all right? Now, this crisis, things have been a little bit screwy. I'm not going to talk about that. What I'm talking about now is just normally what happens when the Fed buys a new asset, throws it on its balance sheet, and gets more reserves in the economy. So what happens is the guy, let's use a concrete example. Let's say Bernanke buys $1 billion worth of bonds from some bond dealer, writes a check to the guy or the company. They put it in their bank account, right? Just like you guys would do if somebody bought something from your business and you had a check. What do? You go to your bank and deposit the check. So the bond dealer's checking account balance goes up by $1 billion, but then the bank where they deposited it, what do they do with it? So they credit their customer's account, they bump up the numbers by $1 billion, but then they take that check and deposit it with the Fed. So now that bank, its own checking account, if you will, with the Fed goes up by $1 billion. All right, and so now here's where the magic of fractional reserve banking comes in. Under normal circumstances now, that bank has what's called $900 million in excess reserves because they only have about a 10% reserve requirement. So you know this, but you go to the bank and you give them $1,000 in cash, they don't just go put it in a drawer somewhere with your name on it, right? They just put it in and they lend out most of it again. So here is the tricky part of the thing that's really perverse. So that bank now can make new loans of up to $900 million. So if somebody needs to buy a house, they come into the bank and say, I want a mortgage for whatever, $250,000. The bank says, okay, they check the guy's credit and whatever. Okay, you got a job, sure. Here you go. And they give that person a checking account for $250,000 that the guy then goes and buys a house with, okay? So where did that $250,000 come from? They just invented it out of, on their balance sheet. They just opened up a checking account, typed in how much does this guy's checking account, it's $250,000. And then, when that comes to clear, they just take part of that $1 billion that was in reserve. While the bond dealer, in his checking account, it still says $1 billion, okay? So that money now is sort of like backing up multiple checking accounts, okay? But the thing I want you to focus on there is that $900 million that has been created, that's now floating around the economy, pushing up prices, that's 9 times as much as what Bernanke created. Okay, so when we try to figure out in the system, where is all this new money coming from? Yes, the Fed is creating it, but in a sense, the Fed creates about 10% of it. And then the other 90%, it's the commercial banks are creating on top of that.